COBRA. COBRA is a pro bono initiative co-founded by Schindler's Attorneys, IQ Business, and Engaged Business Turnaround, offering free legal, accounting, consulting, and turnaround advice to businesses in financial distress. Well, this afternoon, as always, every 2 weeks, we have Singular that join us. And today they have a special guest, Mametja Moshe from Moshe Capital. She'll be joining us together with Lorenzo, and she'll be talking mergers and acquisitions options post-COVID. So this is going to be a very interesting discussion here on COBRA. So if I could just quickly go through the bios of our two guests. Mametja has a wonderful CV. She's the founder and CEO of Moshe Capital, a South African advisory and investment firm specializing in corporate finance, management consulting, and investment across various sectors in Africa. Ms. Moshe has over 17 years experience in corporate finance, equities, capital markets, debt capital markets, Black economic empowerment, accounting, auditing, and corporate tax. She's worked at Morgan Stanley, UBS, and KPMG. She has advised on transactions of well over $10 billion across the African continent, mainly in the mining, telecommunications, agriculture, manufacturing, and consumer products and services. Mametja is a qualified chartered accountant and holds an MBA in the Global Executive Program at Columbia Business School and London Business School, and a BCom Honours in Accounting and a BCom Honours in Management Accounting from the University of KwaZulu-Natal. Just a bit more on Moshe Capital. It's a South African Black woman-owned and run advisory and investment firm with a presence in Johannesburg and London. Welcome, Mametja. Great to have you. As always, Lorenzo is a bit of an in-house guest of ours from Singular, an advisory that have their offices here in Johannesburg. He's head of African operations. Great to have you, Lorenzo. I'm going to hand over to you first.
Excellent. Thanks, Gary, and welcome, Mametja. Good to have you here. So welcome everybody, and thanks for joining us as usual. So I'll quickly go through for a couple of words on the objectives of Singular Compass, just to remind the ones of you that have joined previously, or the ones of you that have not joined previously and that joined for the first time. So we, since the beginning of the lockdown, we've tried to, we've soon realized, as everybody else, of the gravity of the situation. And we've also realized that most decision makers were really overloaded with a massive amount of information, some of which was more, let's say, trying to make headlines rather than necessarily inform people. So we said, let's use our competence base and try and lend a hand to decision makers in the country. And that's how Singular Compass really came about. And in particular, our objective is fourfold, is to provide a level-headed source of input that can become the sort of one-stop shop, one and only, let's say, or main input of information for decision-making for CEOs and senior decision makers in the country. Be practical as much as possible. So we know the situation is negative. We know there is a crisis out there, but let's focus, let's qualify that and focus on what we can do about it, as well as assessing, let's say, the situation on a weekly by weekly basis. And then let's be transparent about the many known unknowns that we have out there. There's a lot of variables we don't know, especially related to the virus, but also related to the ability of the economic system to react to this kind of shock, which is unprecedented. And finally, we try to provide and contribute learnings from our own expertise as a management consulting house and as investors, drawing from the last few crises and drawing from our clients and corporate clients and investors that we help globally face past crises, different other crises, and this same crisis. Okay. So the structure of the document is as the usual. So you're probably used to this setup by now. We quickly will go through an update on the virus and healthcare situation, because obviously this is what cascades into everything else. So how is the situation now? and how could it unfold in South Africa based on what we know now, the best possible information from today. Secondly, how is the economy reacting to what's happening, and how is the economy reacting to the policy that is being put in place locally and globally, and vice versa, how the two are really interacting with each other. So what will happen from an economic standpoint. And then thirdly, how can business react and how is business reacting? That's the third chapter, and typically we make it thematic. This the theme of today, and that's why Mametja is our very welcome guest today. Is very much M&A, acquisitions and private equity buyouts, which are sectors that from different perspectives, both Mametja and I, both Singular and Moshe Capital address. Now, first slide is the usual. We attempt to summarize the situation. What you see on the y-axis is very much the number of, well, the logarithmic number of deaths per million. And on the x-axis, on the horizontal axis, you have the deaths, the total confirmed deaths. So what you see in terms of the inclination lines is the speed at which the fatalities are unfortunately doubling. Now, the speed initially in South Africa was very low, which was very positive, and we always highlighted it as such. Unfortunately, recently in the last, I would say, 4 to 6 weeks, the speed has been increasing, which is obviously a bad news. The good news is that if you look at the order of magnitude in relation to other countries, we are still very far away from, or we are still quite far away from the levels of death per million people that we've seen, especially in Europe and in the United States, and of recent also in places in the Southern Hemisphere like Mexico and Brazil. Now let's look at let's try to also get a sense of where are we at in the curve. So you see on the top part of the slide, you see 3 countries that have seen more or less, sorry Naline, if you don't mind going to the next slide. So you see the top part of the slide really highlights 3 countries that have broadly been over the first wave, hopefully the only wave. And we've seen that more or less from the beginning to the end, this has lasted roughly 3 months. Now on the bottom part of the slide, you obviously see a different case, which is the United States, in which it actually started 3 months ago, but it's still rather on the high side. So we haven't seen this flattening and then changing direction of the curve quite yet. If we look at South Africa and Mexico, we're very much midway through the curve. So if South Africa wants to, as we all hope, and to a big extent it will be clear in the next 2 to 3 weeks that South Africa is heading towards the Spain, Italy, and UK way, this could mean that we are sort of halfway through the curve / 1 month left before things are starting to flatten and then decline. Okay, let's move on to the next page. The other good news, the other good news comes from science, and many of you have probably read the news over the past couple of weeks. There is one specific drug called dexamethasone. I always struggle to pronounce it, but that's, let's say, the good news is that already trials have been done and have highlighted with a decent degree of confidence that actually quite a lot of lives can be saved because we are basically preventing, let's say, bad side effects from happening. Roughly 1 out of 8 patients on ventilator could be spared. Their life could be spared if this drug was used, and 1 out of 25 of the patients on oxygen. Now, the other good news, but for this it will take more time, is that we have already in phase 3 actually 3 possible vaccines of different types and coming from different countries, and this gives us a lot of hope. But at the same time, let's not be naive, because it will still take some time, and even the commercialization phase, especially the early commercialization phase of a vaccine, can take quite a lot of time, and that typically is also where the hurdles and some of the possible side effects that have been undetected appear. So I would say overall good news, great news, but let's not be ahead of ourselves. Another important finding, I mean, we all said weeks ago we were fearing, especially for HIV positive and TB patients in South Africa due to the high percentage of such cases. It turns out that if you look at it in order of magnitude, diabetes in first instance and in second instance hypertension are actually much more dangerous, at least for what we've seen so far, which seems to be a relatively good sample, because the numbers, unfortunately, for now are high. They seem to be much higher risk factors than HIV and TB. So important that we treat, and we treat with maximum care, especially people that have these kinds of complications, and we have them social distancing as much as we possibly can. There's a big new addition to our document, which, by the way, I need to not forget to mention that we publish every week after the webinar on LinkedIn. So you can feel free to link up with my profile or Singular's profile, and you'll receive the full report if you're not on our mailing list. But the big new addition to this this week edition is very much a model that we are co-authoring with NMG. It's actually an NMG model that we've sort of worked on together after their posting, and we came to even more, let's say, hopefully accurate predictions and analysis on the way the slope of the curve could go. According to our assumptions, and as you know, we always have a best case, a base case, and a worst case. You can feel free to obviously have a look at those assumptions and details on the report. But it seems like, obviously, needless to say, we are in a worse position in terms of the shape of the curve vis-a-vis where we were 3 weeks ago and we had the last webinar. So we have to increase, especially after the even more accurate modeling, revisit the estimate of fatalities by the end of August. We think to anywhere between 9 and 23,000 people by the end of August. Okay. This slide basically shows us and allows us to also have a look and estimate based on the estimates of reported infection, unreported infection, number of deaths, and hospital admissions. It especially helps us assess when and if we will run into bad critical care, bad capacity constraints. Now, according to our models, again, the same models done with NMG, we will need actually a substantially higher capacity than what we have of critical care bed, certainly in the worst case scenario, and we will be slightly constrained to medium constraint in the base case and in the best case. So important, if there's anything we can do to speed up the building of or the increasing of capacity at the bottlenecks, whether that is bed or doctors, I think this and the last few weeks really are the time to act there. Now let's move into the political and sort of the policy and economic implication to this crisis. There's one big thesis that we have at Singular, which is that this crisis is going to be just like the last crisis, but probably even more for the reasons that I will be saying in the next slide. But this crisis will be a crisis more of small businesses than a crisis, but than one for large businesses, and it will affect small countries more than it will affect large countries. We've seen exactly the same phenomenon happening in after the 2008 crisis. And unfortunately, we believe this will be even magnified in this crisis, which obviously the call for action here is to policymaker and to all of us to find ways to rebalance the situation. Because if you think about, just take for as an example, in 2008, 2009, the net job loss of companies from 1 to 250 employees in the US has been explaining roughly 60+% of the job losses vis-a-vis a 44% of the total employment base in that particular bracket. So you see there's a big disproportion in the extent to which small businesses and medium businesses have been affected. And in South Africa, small and medium businesses represent roughly 50% of South African employment. So you can see how essential it is that we direct policy measures and help to small and medium businesses. If we move to the next slide here, we see my first argument, which was or my second argument, which was the one that small countries will be hit worst. I mean, unfortunately, the big economies have bigger spending power, and typically have also lower, not always, but have also higher capacity. Either they have because they have lower indebtedness, or just a higher level of confidence on their balance sheet in the market, and therefore they can increase the amount of debt. So the combination of these two things make it such that countries like Germany their stimulus package can be up to as much as 33% of their GDP, which is what we record today, vis-a-vis 3.5% after the 2008 financial crisis. And now you see how this compares, and obviously second you have Japan and France, UK and US, so massive numbers in comparison to GDP. And especially if you compare that to smaller countries like South Africa, whereby even though in percentage of GDP, it's still a relatively big amount. I mean, we're talking about 8.6% of the GDP in terms of stimulus. So we're really talking about stimulus on steroids, as you read on the news. That still doesn't quite compare to the amount of capital that can be deployed by bigger countries, and certainly doesn't compare to the amount, but fortunately, on the other hand, it compares very favorably to the amount and the extent of the response after 2008. If you look at business confidence, which typically is an excellent indicator for the demand effect in terms of what can we expect from business behavior, consumer behavior, business confidence is in South Africa at its lowest point, and it's actually 14% below where it was in the dip of the financial crisis. And of course, we all know that we have the highest unemployment rates right now in South Africa in a decade, and probably even much more. The good news is that, I mean, on the one hand, this has been a massively deep, let's say, fall, not only for South Africa, but globally, because of the various lockdowns and supply shocks. But on the other hand, the good news is that the recovery also seems to be faster than expected. And if you look at the Chinese figures and even the unemployment, I'm talking about export figures right now, so the rebound of exports and the figures on, so how unemployment figures are basically changing direction and starting to diminish in the US. These two indicators are, we believe, great news in terms of the speed at which the recovery is already happening. Obviously, it's happening starting from a very bad point because the dip was so deep. But that's good news and a good, let's say, ray of light out there. Now let's move into the topical. So let's jump into business. And in particular, in this, as I said, in this webinar, we wanted to very much discuss M&A and private equity buyouts. Mametja will talk a little bit more about the M&A environment. I wanted to make some points on the private equity space, which is very close to my heart and our business. So obviously, global buyout transaction fell, I mean, understandably by a large amount, in particular 60% from January to April this year, which is understandable. We've seen this also in the last crisis. The difference is that, well, not the difference, but let's say we certainly have in this particular situation an unprecedented amount of dry powder waiting to be spent. So funds globally have been raising a lot of capital. We are talking about $2.6 trillion, which is 2 times what was the amount in what the amount was in 2013, and this money will be deployed, which is I would argue a good news both for the private equity houses, but also for the economy, because that money will be plunged into the economy. One thing to note, and this is more of a point of view that a private equity house should consider, is the fact that if you look at the IRR, so basically the returns, the compounded returns of deals that were done in 2008 and 2009, or let's say in 2009 rather, so after the dip, those deals, that vintage year, explained an average difference of almost 20 percentage point in IRR. So that's to say that funds that manage to time their acquisition strategy in a way that they would would do value acquisitions at the bottom of the market, they actually increased the IRR, the average IRRs in their for those deals vis-a-vis the rest of the fund by as much as 20% on top, which is actually not 20%, 20 percentage point of IRR, which is gigantic. Somebody's saying. Can you hear me? Can somebody hear me?
I can hear you.
Yes, we can.
Okay, no, sorry, apologies, but there was a message from somebody saying that they couldn't hear. Okay.
There was a small moment where it was choppy, but it's back.
Okay, super. Now, what can private equity firms, what have we seen, let's say, the most successful private equity houses doing in the previous crisis, but also in the current crisis, for the early signs that we start to see is, I mean, what's critical here is obviously allocation of time. So how can you focus your time in the most effective way, in a way that you focus your time on the portfolio companies that have relevance for you and where you have a high ability to win, so an ability to impact, to help them, basically, without taking too much bandwidth away from the origination, screening, and due diligence part of your activity, which is what will determine if you catch the type of returns that we've seen, or extra returns that we've seen in the previous phase. And if you look at, I mean, usually what we see is that the private equities tend to focus 80% of their value enhancement team focus on no more than 20-30% of their portfolio. And in particular, they prioritize vis-a-vis what's of high relevance for them. That obviously is very simple indicators like the share of the fund that particular portfolio company represents, and whether there is a short-term, mid-term prospect for exit. So whether we are close to an exit, in which case we need to address it quickly or more quickly, and then the ability to win, which is the horizontal axis, which basically looks at, I mean, two things. One is the level of the threat, and the other one is the internal ability to intervene. Level of the threat is we need to take a view on the long-term demand effects on the portfolio company. So is there something that we can fix there because it's just temporary, or are consumer behavior changing for good in that particular segment? And then what is the extent of the threat to the balance sheet? Can we fix it? Is it, you know, can the company digest a few months of 30, 40, 50% lower revenues? And I mean, most of the private equities I work with, many of them talk about an average revenue decrease in their portfolio forecast for 2020 of easily 30 to 40% revenue decrease. So that's obviously not trivial, and hence the need to really prioritize where can you make a difference, where can you fix it, where can you focus your energy. And then the other part is obviously what can you do to fix it, because it's all good and great to say that you want to intervene in your portfolio, but do you have the right competences to solve that particular problem? If it's about recapitalizing or bridge financing, then it's, you know, obviously whether you have within your mandate still the ability to do so. But if it's about to operationally intervene, then you need to ask yourself the questions of whether you really truly have a team that is an internal value announcement team that is competent to be able to help in that area. If not, rather not, let's say, complicate things and let management team do as they can. Okay. So what opportunities do we see out there specifically in South Africa? I mean, this is to some extent true globally, certainly also specifically in South Africa. I mean, there's three broad themes that, I mean, beyond the healthcare topic, which we think in many subsegments is more of a, let's say, short to mid-term opportunity. So not necessarily differential vis-a-vis what was there before, if you look at it with a 5 to 10 year horizon. But there's really three broad themes. I mean, one is the falling angels, which is basically companies with low growth prospects, but that you can acquire at very high value for money, because and obviously that happens only when the sellers, so when the assets get repriced and the sellers are actually pushed to sell. What we see in the market that already, I mean, you've probably read on the news about Sun International, you've probably read on the news about 91 in partnership with Ethos launching a new 10 billion Rand fund to target businesses that are in distress. You probably have read the news about a lot of the property funds that are in trouble, and therefore investments are gathering in some shape or form to acquire them, buy them out, and rescue them. So there's a few themes within this macro theme, but that's very much the number one. The number two is what we call the Green New World. Now, what this means is nothing materially different from what existed the day before COVID. It's just that the speed, we'll see the speed at which, let's call this Green New World theme will continue is just increased. So we'll see a change in speed at which things like, and if you look at South Africa, I mean, renewables. Is there now a time to really shift the gear when it comes to renewable? It seems like this is the case if you look at what African Rainbow Capital Investments has done. If you look at the new, let's say, IPP discussions, and a lot of the acquisitions that are either in the making or in the thinking in that space. Renewables are obviously not the only one. A lot of ESG driven or related investments are absolutely within this theme, and therefore fall within the, if you think about the mining sector, how does the mining sector react to a theme like this? Typically by investing into the new battery metals, the new minerals, so that they can play within this new theme. So this new theme doesn't mean just renewable. You can look at it across sectors, across the value chain. And then the third one is the digital runners. This one is the very easy one to imagine, because this is another big trend, big theme that was existent before COVID, but it's just changing speed. If you look at the rate at which the digital penetration has increased in countries like Italy, but also South Africa, it has done the increase in penetration that it would have done in 3 months, that it would have done in 5 years pre-COVID. So this is here to stay. And the speed will maybe slow down a little bit, but the increase in speed vis-a-vis before is absolutely guaranteed. Yeah. And needless to say, this, I mean, everybody thinks fintech, thinks health tech, and so on and so forth, but there's also a lot of play in the infrastructure space behind the digitization of businesses, of especially of businesses. Yeah. So there's a lot of sub-themes within this that I think are becoming and are already extremely. The government itself and just unveiled a plan to galvanize, to basically put in another 2.3 trillion Rand into new infrastructure investments, including digital infrastructure. So this is something that will not only be driven by private sector, but also incentivized, hopefully, by and pushed by government. So creating the momentum there. Excellent. So said that, I'm very happy and glad to pass on the word to my friend Mametja, and I'll leave you in good hands, and then she'll walk us through her perspective and Moshe Capital's perspective on the South African M&A space and what's happening in the market from where she stands.
Thank you, Lorenzo, for the invitation, and thanks to Singular, our partners, as well as Gary and COBRA for the invitation. Amidst COVID-19 pandemic and the distress as we are all facing GDP contraction of 7 to 10%, I hope that in the next 10 minutes or so, I can bring a little bit of light when we look at what has happened and what are the opportunities that we see. On the first slide here, we just wanted to talk about what have we seen since COVID started before we actually go into what the opportunities are. On the left side, we look at the stock markets. What have the stock markets done? So since the World Health Organization declared the COVID pandemic on 30 January 2020, the JSE All Share has gone down by 4%, which is in line with the S&P 500. So, when you look at the impact from the stock markets, it has really recovered from where we were when this announcement was made. And then secondly, the mining and industrial sectors seem to have recovered back to performance prior to COVID, at the start of the pandemic. And obviously there was the initial shock that came in when lockdown was announced, where the stock markets crashed, but we seem to be back online to where we were when COVID started. Now, what would be interesting is on the right-hand side, when we look at private equity and M&A activity, on the top right, you will see that despite the COVID pandemic, in Q1 2020, we've seen best performance of a first quarter over the last 5 years, both in terms of the number of deals and the quantity, as in the ZAR amount of performance. And obviously, these were transactions that came in prior to COVID-19. So there has still been activity on deals being closed in the market, both acquisitions, disposals, and there have been some JVs. What is not included on this page, which I want to touch on, is when you look at capital raises in South Africa and on the JSE, we've seen about $1 billion of capital raise. When you compare it to the rest of the markets globally, that is really insignificant. When you look at the UK on the public markets, on the equity side, the capital raises have been over $13 billion. And this is obviously slightly also a reflection of where we were. Let's not forget how, as South Africa, we came into COVID pandemic. We were already seeing a recession. We were already seeing re-ratings of our credit as well. So that is a reflection of that. Now, going into the next slide, let's look at a little bit on what have corporates and private equity firms been doing. On the corporate side, there has been two trends. The first one is restructuring of balance sheets. So we've seen a lot of capital raises. Secondly, disposals or plans of disposals of non-core assets. And lastly, making sure that companies have cash and there is sufficient liquidity, because we don't know how long COVID-19 will take. And as we've seen, some of the blue chip listed companies really drew down on existing facilities to make sure that they have that cash available to them and it's not sitting with the banks. And then the second trend has been around operations. Here we've seen, right sizing. I think we've all seen it, right sizing and retrenchments of workforces, as well as cost cutting exercises. Moving on to the private equity world, the first step that private equity, and I think Lorenzo touched on this, where do you see the balance between new assets, so going to hunt, versus harvesting what's at home. So most of private equity firms, and certainly ourselves at Moshe Capital as an investment holding company, the first step that we took was look at portfolio companies, ensure that our portfolio companies are operating well. And talking to Savka, I mean, I've seen a lot of our peers as well, private equity firms and investment holding companies spending a lot of time. In the beginning, it was in some instances daily, in some instances weekly, and it revolved around three trends. The first one was looking at strategies. How are we doing? Is there things we can pivot into? Secondly, how's our liquidity? And I mean, most companies, I think, went into this looking at a 6-month liquidity, but you quickly realize that the plans should be a 12 to 18 months, solely because we do not know how long the pandemic will take, and the recovery is going to be much longer than initially anticipated. And then another trend is also obviously disposal of non-core assets and securing equity capital partners. But another thing, or that another trend that we've seen in private equity firms is firms going back to their LPs to raise further capital. One, for follow-ons into equity of existing portfolio companies. And secondly, for bolt-on acquisitions. We will see a lot of bolt-on acquisitions. So companies that are great can actually get lower valued assets, but quality assets that only lack the liquidity. So if you have cash to acquire, this could be a great time to do that. And I think Lorenzo also spoke about that. And then the other thing which has been surprising, I guess, from my end is around capital raises by GPs themselves. So there have been new funds that have been raised. So as an example, Capital Works raised $5 billion from Morgan Stanley, and Passion Square Capital Management in the US is planning a $4 billion capital raise, even in these markets. And I guess also, you know, things around ESG, impact investment, and with what has happened in the US around George Floyd and all of us realizing that we need to have a voice as minorities, there's also investments into that minority space. So there's a lot of capital raise that is assigned to supporting minority businesses, especially around SMEs, which is what is needed at this point in time. At the bottom of this page, we speak to what are the things that the themes that we're seeing as people are doing M&A and private equity deals. I mean, the first thing is that deal lead times are much longer. Or everyone that is investing is taking their time to do thorough due diligences. There's a lot of investment committee decisions that are made where investors and investment committees are more risk averse, and also ensuring that for each and every risk identified, there is mitigating factors. But we're also seeing themes around ensuring that contracts are resilient, ensuring that checking if there's support from government. Are your IT systems working as well as they should? Can you work remotely? But most importantly, and I think this applies both to GPs and to investee companies, is the power of management teams. Not in this time, it has been extremely critical to have the best management teams. And I think, you know, as the GPs and investors, we always look at management teams, but this time has actually shown that management teams are critical. One, the teams that have acted calmly and put strategies in place, as well as acted fast, are the ones that have managed to keep their companies steady. There's also a lot of MAC clauses, so material adverse changes clauses that are being put in place to make sure that one can actually come out of a transaction if need be. And then the fourth point that I wanted to make is around valuations. Valuations have been quite difficult because we all don't know what the future is going to bring, and history is not going to necessarily reflect the future. So there are a lot of valuation gaps between sellers and buyers, and this can be mitigated, and innovation is also needed here. So we've seen a lot of clawbacks, a lot of earn-out structures where management teams and sellers are paid depending on what the performance will be in the future. And we've also seen a lot of share considerations instead of pure cash consideration. There are also a lot of warranties and indemnities that are being put in place. And obviously, some of those came from the COVID-19 effects. Now, going into the last page, which is where it gets meaty and why we're all here, which is where are the opportunities? It currently is a buyer's market. So companies that have strong balance sheets and cash right now have an opportunity to do acquisitions of strong assets with great profitability that might be lacking on strong balance sheets as well as cash. So we're seeing a lot of corporates looking for companies that can bring synergies or vertical integration. From corporates, we're also seeing blue chip companies disposing of non-core assets, which bring opportunities, especially for private equity investors. On the private equity side, we are seeing increased private equity acquisitions. As Lorenzo mentioned, when you look at 2008, 2009, the companies that were, or the private equity players that were able to acquire companies quickly, but with innovation of structuring, came out with the best returns. So as private equity players, when you have a capital right now, it is a good time to acquire to realize great returns. We're also seeing a lot of SMEs looking for equity partners. What has been different between, I guess, this timing and other times around SMEs looking for partners is that SMEs are not only looking for cash, they are actually looking for active investors. They want investors that can actually contribute to their strategies, that can contribute to their capital structurings, as well as innovation on where to pivot their businesses to. There's a lot of delisting opportunities that we've seen as well. Certainly at Moshe Capital, the first thing that we did as the markets were crashing is look at the stock markets. And we've looked at companies below 5 billion rands and said, which of these companies are good targets and have great underlying operations, but are now either cash strapped or need to be taken off the stock markets, because it's an expensive exercise to be on the stock market, as we all know. So if you're looking for opportunities below that 5 billion mark, please feel free to touch base with us. We've put together a list of certain companies that we believe could be great targets. I've spoken to the disposal of non-core assets by majors, which is also coming through. As an example, I mean, Telkom has mentioned that they want to dispose of the towers businesses and the non-cores, which are about 12 billion rands worth. So we'll see a lot of that, of those trends. And we've seen a lot of blue chip listed companies coming to us to request help on that, on the disposal of their assets. Another trend that we've seen is around the type of funding. Typically, we know only the plain vanilla debt or equity markets, but we're seeing a lot of hybrid structures. In fact, a lot of also alternative investment funds that are being raised in the market. So we're seeing quasi-equity instruments such as mezzanines and convertible debt instruments. But it's time for innovation, but into structures that actually work for the sellers as well as the investors. So we're seeing a lot of alternative investments coming into the market. Another trend which Lorenzo mentioned is around foreign direct investment. I think this is going to be another big trend. So for companies looking to sell some of their businesses, there will be, and the delistings, there will be a trend where foreign companies are coming into South Africa. And we saw the same around 2008, 2009. And obviously this is because the assets have lower valuations, but also we've seen the rent devalue extensively. So with the rent devaluation, assets are coming in quite cheap. When it comes to sectors, Lorenzo has already touched on some of the sectors that we've seen as well. Tech is top of mind for everyone. Online, everything. We're all using Zoom, Microsoft Teams. Some people house party after hours. But tech and online is becoming quite key. I certainly have used, as an example from a South African point of view, Zulzi, which was an app that previously did not take on quite quickly, but in these times has actually seen great performance. Not only that, but they've also partnered with Checkers to do the 60-minute delivery, which I think most of us have been using. So there is a lot of innovation in South Africa around tech. So we'll be seeing online healthcare, online schooling, online financial services. I do not see a lot of us still going back to the point of drawing cash. There's so many alternatives that are coming out in the market. Another trend that we've seen at Moshe Capital is around healthcare and life sciences. There is a lot of requests on companies that are around healthcare and more importantly around organic foods. Our partners, VSA Capital, as an example, through that we've seen a lot of requests from China on agricultural businesses. So be it primary agri, but more so we've seen a lot on the secondary agri. And I think, lastly, this is time for innovation. The deals are out there to be done. There's still great businesses out there that require capital. So the cash is king right now. If you have cash, you can actually get great assets at very, very good valuations. And lastly, the one thing that I had not mentioned was around distressed assets. There's a lot of distressed M&A that we've seen. So, just to sum it up, the M&A and private equity space has not been as bad as we perceived from outside. It is terrible, but it's not as bad as we've seen from outside. The markets on the JSE have kind of recovered. Of course, the economy is doing badly, but we see opportunities for activity on private equity and on M&A where there is consolidations, as well as taking opportunities of lower valuations. But what we need to do is ensure that from a structuring point of view, there are certain innovation that is brought in to curb the risks. And lastly, using hybrid instruments is also critical. Thank you.
Excellent. Can you hear me? Please?
Yeah.
Hello, can you hear me?
Yeah, we can hear you.
Okay, perfect. Sorry, I'm struggling today with my microphone. Thanks, Mametja. Thanks a lot. I think we need to do a few. We will need to be succinct in the Q&A, which is a little bit against my nature and probably also Mametja's. So we'll try our best. But maybe let me read out a couple of questions and then we throw it to myself and Mametja. The one question from Rogan: what do you think private equity firms will be looking for in post-COVID era if the revenue growth is not a given in the medium term? So let me maybe make a quick comment and then I'll pass it on to you, Mametja. I think, to be honest, it's in this phase, it's going to be either, it's really one of the two options. So either you're betting on buying much lower than the intrinsic value, in which case you're happy to take the hit for a couple of years on revenue, so long as you believe that the long-term revenue is not materially affected in the particular sector where you're about to buy, and that's the one big theme. And the other one is obviously you do look at growth, but that is in very, very small niches that are either the digital, the sort of green related niches, healthcare in some spaces or subspaces. So these are really the two things that I think private equities are looking at. And of course, if you look at Europe and the US, they will be looking at hopefully taking advantage of the low interest rates, which will allow them to potentially to potentially lever up deals quite substantially, which increases the overall returns. So I think it's going to be a mix of these three things. What's important is to make a judgment call on the long-term revenue hit vis-a-vis short to mid-term revenue hit. They cannot, most private equities can take a short-term, mid-term revenue hit if the company is going to be healthy long-term.
The other, I mean, thanks, Lou, and I totally agree. The other thing we've seen is, and this applied for us on our portfolio companies, but also on companies that we've been looking at, is scenario planning. So there's even a paper, if I'm not mistaken, by Savka that speaks to this, where you need to look at different scenarios, and based on the scenarios, then you can figure out where you are comfortable investing. So, and in those scenario planning, you look at obviously different revenue cases in the next 3 to 5 years. But I found that is extremely helpful in analyzing what could be the lay of the land in the company that we're entering into or we are acquiring.
Yeah. There's a question from Russell. Do we think that the South African economy can be opened up faster now, given the low COVID fatality rate in comparison to the fast looming economic crisis, with risks of social unrest as a result thereof? Well, I mean, this is, of course, the $1 million or $1 billion question, really. My personal view is that there's very little option on the table to not reopen. So the opening needs to happen. Obviously, how the opening happens is the key to making sure that the fatality stays low, hopefully lower than it is today. I mean, let's say the rate is fine, but the numbers in absolute terms obviously is not is problematic in this phase. So I think that it's an and situation. We have to reopen, and we have to ensure social distancing as much as we possibly can, and we have to expand capacity in the healthcare system as much as we possibly can. Unfortunately, there's really no, that I see, there's really no silver bullet. Every country had their own theory. At the end of the day, this has been very much, I think, the general learning, and you see the mistakes of certain countries playing out. So the problem has been not so much the theory, but more the execution. Mametja, do you have a perspective on this?
Yeah, I mean, I agree, Lo, and I mean, from a South African point of view, we need to open but cautiously, and the numbers in the last weeks have been, I mean, certainly for me, I think they've been a bit troubling, and the next 3 weeks, as we're getting to the peak, will inform what is next. The numbers have, however, been increasing at a much faster rate, but our economy does need to be opened up with caution on which sectors and how and why.
There's a question on from Fabian. For investments focused into distressed businesses, how can we play a more active, proactive role? Are the banks or other institutions sharing openly? I mean, typically, yes, in the sense that, typically it's in the interest of the banks to make sure that the deals happen, so they do share rather openly to qualified investors. Of course, COBRA itself, and I mean, Gary, correct me if I'm wrong, but COBRA itself gets, by virtue of the role that is playing, we are getting quite a lot of, let's say, we are allowing and being able to do quite a lot of connecting potentially interested investors into companies that are struggling. So COBRA itself, I think, can be
definitely an avenue for if you need investing. Then come to COBRA, and through COBRA we can put you in touch with Lorenzo and Moshe and Mametja. So I think, yeah, definitely come to COBRA. I think we put the website address up, www.cobra.org.za, and then we can help you to get in touch with Lorenzo and Mametja.
Yep. We found the same in our network. We do see a lot of distressed assets, alignment to business rescue practitioners, alignment to developmental finance institutions. But yeah, I think it's best to go through COBRA, and you'll be put in touch with us for opportunities.
Perfect. Lorenzo, should we take a few more questions?
Yeah, do we believe deals will use less debt going forward so businesses have stronger balance sheet in tough times? Is that somewhat forced upon PE firms as banks are more conservative and unlikely to provide more than 2 times EBITDA in senior debt? If this is the case, how does PE firm get strong returns if growth looks muted and the ability to use cheap debt will be reduced? Yeah, I think this is a question it's a very good question from Keval. I hope I pronounced it right. So of course, on the one hand, you have low interest rate. On the other hand, what you'll typically see possibly is a bit of a credit crunch in which banks are more cautious. Private equities themselves are more cautious because they have more uncertainty on the EBITDA. So certainly, what you're stating here is certainly true for a phase in the crisis. Now, we all hope that this phase will be slow, it will be small, will be short, but that depends very much on the perspective I had. But I do foresee a phase in which what you write here and what I just repeated will happen, and is probably happening already.
The other thing I would add is, I think I spoke to it during the presentation, is around hybrid instruments. So hybrid instruments will be key at this point in time, and those would be helpful in terms of bridging between the, as a typical plain vanilla debt and where the private equity companies will come in. The trick is to get the balance between buying quite low, in injecting enough of the senior debt and finding the right hybrid structures such as the mezzanine, which of course will realize closer returns to yourselves, but actually they come in handy in terms of taking up the differential on the required capital.
Excellent. Maybe one last one. This is from Rukesh, MD Construction, have seen a significant increase in demand for funding partners for infrastructure projects. Are private equity and venture capital companies keen to explore funding these projects with a construction company like us? I mean, what I can certainly say, well, first of all, I'm very happy to sort of connect you with a couple of parties that might be interested. But also, I think the more the infrastructure has, let's say, a degree of a hard asset with a long-term, let's say, cash flow, foreseeable cash flow, and ideally low risk in construction phase, I think the more you fall into the defensive type of investment space, which should be more prevalent rather than not in the coming phase. So I would say these kinds of stuff will be, if they have these 2 characteristics, will be very palatable.
Yep. We've also seen, I mean, I don't know what what part of infrastructure the person who asks is playing in, but when it comes to renewable energy, we are seeing a surge on requests for renewable energy play from private equity players, from corporates, from international, so FD, foreign direct investment, from international partners looking for that defensive portfolio. And there are quite a number of infrastructure funds that are actively looking at transactions, and a few that have been closed in the last 3 to 6 months.
Excellent. Gary, I think we thank you a lot. I'll leave it to you to close the conversation. In the meantime, I just thank Mametja, of course, for joining, and COBRA, as usual, for hosting us. You are always great hosts, and for everybody for joining us today.
Great, thank you. Thank you, Mametja, and thank you, Lorenzo. Lorenzo from Singular and Mametja from Moshe Capital. If you have any other questions with regard to mergers and acquisitions, you want to get hold of Mametja and Lorenzo, please go to cobra.org.za, get the details, or send an email to info@cobra.org.za. Coming up next week, as you can see on the slides, Catherine Young is the founder of Think Room. She'll be on COBRA to discuss selling during COVID-19. We've also got Alon Reis from Reis Corp. He's a business incubator expert. He'll come onto the show on Tuesday. And then Wednesday, Pepe Marais is in the advertising space. Those that have an interest in advertising, please join us. But please join us for all these webinars. They are free. COBRA offers free advice also to you if you a company that requires financial assistance during this pandemic. Please come to COBRA. We offer a whole range of advice from consulting, turnaround advice, financial turnaround advice, legal advice, all types of advice. It's all pro bono, so please join us and get involved, and we'll assist you. Until next week, from the COBRA team, it's goodbye.
Excellent. Thank you very much.
Thank you.